Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one of the so-called passive funds that sits within our list of 72 favourite funds, namely the Fidelity Index World Fund. This is a tracker fund designed to track or follow the performance of the underlying assets and deliver that performance minus the fund's running costs. In this case, the fund is tracking the MSCI World Index, which includes over 1,600 large and mid-cap stocks from the globe's 23 developed stock markets. It has no exposure to emerging or frontier arenas. The largest individual shareholdings are in essence the world's biggest companies by stock market valuation. So that means Apple, Microsoft, Amazon.com, Facebook, JP Morgan Chase, Johnson & Johnson and ExxonMobil. Also note that among the top 10 holdings in the fund, there's also a position in the futures markets on the American S&P 500 stock index and also a holding in a Fidelity cash fund. Note that the top 10 holdings represent just 13% of the £787 million in assets under management. So any buyers are getting very diversified exposure to the world's stock markets, and the fund's got over 1,650 holdings in all. By country, America is the biggest exposure, as you would expect given it's the world's biggest stock market, and that's 59% of the fund. Next come the Eurozone at 12%, Japan at just under 9%, and the UK at 6.5%. By sector, the three biggest weightings are the financial services, technology and consumer discretionary stocks, and their sectors, and they're at 19, 16 and 12% of the fund. Real estate, utilities and telecoms, well, they're the smallest sector weightings, 2, 3 and 3.5% of the assets respectively. 7/8 of the fund is in mega and large caps, with the rest in mid caps, nothing in small caps. The fund comes with a historic dividend yield of around 1.8%, and dividends are paid every 6 months. We're talking about the fund's accumulation units in this case, so those dividends will be automatically reinvested for you. The ongoing charge figure is just 0.12%, cheaper than actively managed global equity funds, as there are no managers or research to pay for, although this index or this tracker will never beat its index, which is what an active fund will definitely try to do to justify the higher fees. This class of tracker funds is 4 years old, and it comes with a 4-star ranking from Morningstar for those who put value in such things. As a final point, Fidelity Index World Fund is eligible for SIPs, ISAs and dealing accounts, and the minimum investment's just the one share, which as I sit here will cost around 178p. Those are the mechanics. The next question to address is, why could an investor consider Fidelity Index World Fund for portfolio inclusion today? Well, you get low cost, widely diversified exposure to the global stock market and limited exposure to the UK. So if the global bull run continues, this may be one way of playing it. This chart shows the underlying MSCI World Index over the last 10 years, but what you really need to ask yourself is why this long bull run can continue, and if not, what are the lurking dangers that could suddenly stop it in its tracks? I'd suggest the following 5 points argue for further gains in global share prices. 1. Buoyed by President Trump's tax cuts, America's economy is going gangbusters, and since it's the world's biggest economy, all boats may rise with its tide, supporting the current narrative of a globally synchronized recovery. 2. Inflation remains fairly tame, undershooting central banks' 2% target in Japan and Europe, and exceeding it only marginally in the US and UK. 3. This means interest rates are rising only slowly in America, at a truly glacial pace in the UK, perhaps from September 2019 in Europe, and not at all in Japan. Rotten returns on cash and low bond yields may therefore continue to force money into stocks. 4. Global merger and acquisition activity keeps bubbling along to suggest that there's still some value in global markets, while these deals return cash which investors can then put back into the markets. And 5. Global share buyback activity is also running at or near record pace, again returning cash to investors which they can plough back into other shares. However, there are also 5 counter-arguments which could suggest that care is needed, as share prices may find it harder to progress from here or even are at risk of a fall. First, look at this chart. The MSCI World's made a capital gain of around 0.5% to date in 2018, despite all of the good news I've just outlined. In sterling terms, the total return including dividend reinvestment, well, that's just shy of 5%. Note how Asia and Western Europe have struggled, and Latin America has just taken a clobbering. America is doing best, but a lot of that's down to strength in the dollar against the pound. All of this may suggest a lot of good news could already be in the price. And in America, it is easy to argue that valuations are rich by historic standards, particularly if you look at metrics like market cap to GDP or Professor Robert Shiller's cyclically adjusted price-earnings ratio, or CAPE. We can see that here. On this metric, US stocks have only been this or more expensive 3 times: 1929, 2000 and 2007, and disaster followed each time. Second, American interest rates are rising, the Federal Reserve is withdrawing quantitative easing, and the European Central Bank's about to stop adding to QE, so share prices may well have less cheap money upon which to feed. Third, this has been an unusually long share bull market and an unusually long economic upturn, particularly in America. Since 1945, the average American economic expansions lasted about 6 years, with the longest lasting 10, and we're just under 10 years now, so we're kind of overdue a slowdown or a dip. Fourth, markets are doing their best to ignore geopolitical concerns such as Brexit in the UK, the rise of anti-EU parties in Italy, rising global indebtedness, a rising dollar, a strong oil price, and the prospect of trade wars as America, the European Union and China exchange tit-for-tat tariffs. Fifth and finally, record merger and acquisition and buyback activity, well, they're all well and good, but they do tend to occur near the top of stock market cycles when animal spirits are running, not near the bottom. Now, we all know that the past is no guarantee for the future, but what all of this does go to show is that you must do your research to ensure that the Fidelity Index World Fund fits with your own personal overall investment strategy, target returns, time horizon, and appetite for risk before you think of putting any capital to work and indeed at risk. Thank you for watching, and I look forward to seeing you next time.